All right, so I wanted to go in today and talk about a few different things. I think it's really interesting what's been happening in the housing market as of recent. It's been incredibly interesting to see some of the houses that have been posted up over the past like 2 years. So we understand that the market has went absolutely ballistic in 2021. We saw a huge inflow of first-time home buyers on their homes for the first-time home buyers. But okay, so these are the historic inflation rates for Canada. Okay, from 1990 to 2022. Inflation's at low levels, and interest rates are sitting pretty reasonable. In 2020, they were sitting the overnight rate at about 1.75. So the overnight rate is the amount or the price, the premium that banks use to lend money to each other. Bank of Canada or the Federal Reserve in the US, when they decide to increase interest rates, it kind of changes things. What it does is it's changing the overnight rate, which means that it's more expensive for me to now lend money, or I guess it's more expensive for me to borrow money between those banks. Okay, it's more expensive to borrow money. Now, they're not going to just take that on and kind of take that to the pocketbook. They pass it on to the second level. Forward, you actually understand what I'm talking about. It's at 1.75%. So between these banks, so this is a bank, between these different banks, they will borrow money from each other at 1.75%. Okay, this is a bank. Oh, this is great drawing. This is supposed to be B bank. Okay, so this is super questionable, but this is just to illustrate something before we start off. So between banks, we have this overnight rate, which is a low cost to borrow money. When it's passed on to the consumer, that has a premium. So it's like 1.75 plus their rate, which in this case would be 2.25%. Okay. So let's say prime plus 2.25%. So people are qualifying for mortgages at 4% in this example. Okay. Now where this can I go new without? We're going to save this just in case. Make sure that we actually. Okay. And our homeowners, I think I'm getting better at this. Our homeowners from the banks are getting, let's say, plus 2.5. So they're getting an interest rate of, actually, I think at one point, I think it was a low of like I think you get like 1.6 on stuff. So let's even say, sure, 1.65, 165 basis points for a mortgage. And so fixed rate is always going to be a little bit more than that. So let's say you go 195 basis points for fixed. So it's probably a little bit more than that. So now people are getting in at these levels here, down here in COVID, and they are getting some really, really cheap interest rates. So instead of being all the way up here on our graph, they're getting interest rates here. So they're getting it right around here, right around where the banks prior to were passing money and borrowing money from each other, 1.75%. There's people that were, could lock that in or could get in at a mortgage at that. Now, what that means is that if you have a lower mortgage rate or mortgage interest rate, I should say, you're going to qualify for more money because down the amount that your budget can handle, less of it is going towards interest over time, and more of it is going to principal. Well, yes, it's cheaper to get that house. Is when you're in this space and you have this mortgage kind of sitting around, I don't know, call it 2%. You're getting into these low rates. People feel like they have more money than they do. You can borrow, you can get a line of credit, you can do all this stuff, and it's at like dirt cheap interest rates. So people are, especially at the beginning of COVID, people were really kind of financially hesitant and kind of checking in on their finances. And then around here in 2021, things started going a little bit crazy. Okay, people started buying a ton of houses. So this is going to go right into our documents here because I am a nerd and I spent a bunch of time going through. These are all from the CMHC, so the Canadian Mortgage and Housing Corporation. This is an organization that is meant to help kind of increase first-time home buyers in the market and monitor trends in the housing market. And we're going to use it as a kind of statistical and analytical guide on what's happening out there and kind of jumping into this 2021. Prior to, we had a little bit of a dip in 2015. We came out of that in terms of interest rates. People were qualifying in say 2018, 2019, 4-5%. That's where we're at. COVID hits. We drop interest rates an absolute ton down to our baseline where we were until beginning of this year. At 0.25 for the overnight borrowing rate. So again, that is between institutions. That is your base level of borrowing. And they're passing on, let's say, 200 basis points, 2% interest for home buyers kind of in that space. Okay. Now these home buyers, we have a graphic for this. So now in COVID, this is where we can start to analyze what was happening in 2021 and why housing prices went through the roof and where we're sitting now. Okay, you have to ignore these other blotches for now. We're just focused here. So high real estate demand for a few reasons. A, COVID had some really low interest rates. As we said, our people were getting in at very low rates. A lot of situations actually changed as well. People got laid off. People were working from home. Maybe if they had kids, families, everybody's at home. They're trying to work from home. Maybe they go, we need a bigger house. Maybe there's separation or divorce. They need 2 smaller houses. Maybe they decide this is a great time to get they're spending more time at home. They want to do some renos. The amount of renos that were done in 2020 and 2021 were incredible. There's situations that change in people's lives, so they're starting to reevaluate. They haven't had to spend this much time at home, and so there's an opportunity to change their living situation. Simple as that. So there's a little bit more buying and selling going on, so needing more or less house. So this is from the CMHC report. Wow, that actually worked. That's awesome. So high levels, so what is this? Economic conditions and housing indicators. So this quarterly financial report that we're going to be looking at and using as a baseline for analysis is from the third quarter ending September 2021. Okay, now this is their financial report, but the information in it is more what we're paying attention to here from this because they're looking at the outlooks, they're talking about this, and it's kind of a good resource to give us some perspective. So high levels of housing market activity seen in the first half of 2020 continued in the first 9 months of 2021. Home resales somewhat moderate over the summer, but remained elevated. Canada's MLS price averaged a record high of $678,000 during the first 9 months of 2021. It's a 23% increase from the same period in 2020. A 23% increase in from the same period last year. That's incredible. The average price went up 23% in a year. We haven't seen the inflation highs hit at that point. This is just simply from the supply and demand coming from people changing situations, needing more, needing less house. Things are going on here. There's a lot of buying happening. Okay. We go into the next thing. So there are adjusted rates, whatever. Low borrowing costs, because again, interest rates are down. Lower negative impacts from the pandemic on higher income households. So people that are making more money, this is having less of an impact. They're working from home. They're still making their money. They're not, frontline working at the malls or retail where they're getting fewer and fewer hours or not getting the customers. They're getting laid off. No, these are the higher income that they're talking about. Changes in buyers' preference for more living space and limited supply all supported the strength in the housing market. Downside risks include consumer hesitancy, unexpectedly stronger and more persistent inflationary pressures leading to higher interest and mortgage rates, and the evolution of new COVID-19 variants globally. We're at 1%. 2%. We've been kind of 1-2%. Here we're at 2, 3, 2.5, 3.4. So we're up a little bit here. Okay, August, September, we're coming into some higher numbers for sure, but it's it's not even close to where it was here. That was is something that they see. Also, household debt to disposable income ratios have also returned to elevated levels, registering at 173% in the third quarter of 2021. This high debt position could magnify the negative impacts from other downside risks. Going forward, CMHC will continue to monitor signs of increased housing market vulnerability. In 2022 and 2023, the growth in prices will moderate with sales and starts activity remaining above long-run averages. Homeownership affordability will decline, with the growth in prices expected to outpace income growth. Rental affordability will also set to decline from increasing rental demand and low stocks of rental housing, meaning that in the long run, they're seeing that homeownership affordability will decline. Homeownership affordability will decline because not just as interest rates go up, but also as the price of homes go up, there is only so much you can do. It is going to decline the amount of people that can afford a home, as we have continued to see. Gen Z, millennials are, much worse position trying to get into the real estate market and own a home. It's quite difficult to say the least. So let's jump through and just say forecast in Canada. So this is 2019, 2020, 2021, 2022, 2023, 2024. In 2019, that was for a $500,000 house across Canada, was now going to be in a position of 567 to 687, 688. Say, okay, and then it goes to 740, 743, 756. So it kind of tapers off. The mortgage rate for a fixed mortgage rate. So I was saying 4 or 5% in 2019. So that's kind of close. 2020 and 2021, 3.7, 3.3. So your variable rate would be much lower. That would be your qualifying it to say 200 basis points, so 2%. And then you have coming in here quite a bit higher, even higher on this end, getting up to 4.7. So that's more expensive. So we have a higher cost of a house if somebody's trying to get in, a much higher, almost 50% higher, not almost, pretty much 50% higher than it was 4 years prior. And the interest rate that you're going to be paying on that is significantly higher. So that's what they're talking about. It's going to push people out. Downside risks to the outlook, more persistent supply chain disruptions and tighter labor markets, leading to stronger than expected inflation pressures and interest rates. So now we're in a situation where rates are low. More people are opting for a variable rate mortgage than fixed rate because they can get even lower rates with it. And it also allows them to qualify for more. The lower interest rate that they have, the more they can qualify with. This stress test is looking at whatever interest rate that they have, about 2% on top of that. Can they still afford it? Well, if they can, with that 2%, they're okay. But if the Fed actually increases rates beyond that, well, trying to buy. So people are giving up, the rights for home inspections here. There no condition offers on houses before they have even seen the locations. It was a crazy time. 6.7% for April, 8.5% in the U.S. for April. War in Ukraine is putting supply shortages. We also have money printing going on. So with this combination of inflation, interest rates are going to go up to try to counter that. Okay, as interest rates go up, it reduces spending because it's more beneficial or more cost effective to, instead of being borrowing at these higher and higher interest rates, you're more incentivized to keep your money or save it. So in June, we will have our next 50-point basis hike. And from where we are at now, so we're already at 1.75%. If this stress test is 2%, well, we can only go up another, we can't even go up another two of these big basis point hikes before people that qualified back when everything was a little bit cheaper, a little bit lower here. If they're on that variable rate, they're coming all the way back up. You know, we see the forecast here that if CMHC forecasts that we're going to get all the way up to and staying about, just under 3%, that means that people will be up in that 5%, well, people were already in, 4.3% right around here. Well, 4.3% at 1.75, 2.75, add another basis point on there. So 4.3 is 5.3, call it almost 6% interest is what people are going to start seeing when we get up at this by the, this will be where we are now. So we're going to get our next couple rate increases and get us all the way up there. That's a scary place to be. If you have a 2% stress test from wherever you get it, so, at 25 basis points, so let's say they qualify for 2%. If this goes up to here, they're out of the market. They can't afford that. Or they're paying, well, that's passing their stress test, right? And how many people do we know bought houses in here, stretching their budget, get too expensive for people, they're going to have to walk away from their houses, it will be too high and will cause some defaults. Now this can kind of perpetuate further and further and cause a lot of selling, so a lot of increase in supply. Inflation is spiking, it's getting hot. And then we have our interest rate hikes here. We had 0.25 in the beginning of the year, and then we had 0.5 in March. And this 0.5 will be for June. And then we won't have another one until September. So come September, they may have to, especially if inflation is continuing to go high. We go to the next one here. So then as this increases, we have an overwhelming between mortgage and just debts in general. A lot of people defaulting. And then rapid selling of homes tanks the prices. So this is the government right now. I think this is kind of a funny little graphic. I'd like to give myself credit. I made it. I had the idea of it, I guess, because a lot of these are pre-made, but that's okay. So the government has to throw one of these into the fire. Okay, this is interest rate hikes. They either don't increase the interest rates, and inflation can get super out of control really fast, or they increase interest rates to control the inflation, and they cause an economic disaster because they have a bunch of people that are then pushed out of their homes because they can't afford them, and that can have a huge devastating impact kind of across Canada. And and this whole premise is the exact same in the US. We're seeing larger amounts of inflation, but they see the very similar kind of trends. But I'm talking specifically Canada here, especially Calgary, Vancouver, and Toronto. So thank you so much for tuning in. Hopefully that was informative, kind of broke down what's going on and why there is some big pressures out there. I think the graphics were a lot better this time, but I do need to also continue to work on my articulation without over explanation. Quick to the point and not rambling. I think that is going to be my key.